Hello, everyone, and welcome to ByteTree's review of the second quarter of 2026. It has been a truly fascinating few months in financial markets. Korea has stolen many of the headlines in equity markets as retail investors load up on debt to pile in after a monster run. The Iran war was forecast to end dozens of times, and when the ceasefire finally came, it proved short-lived. Oil has spiked, crashed, and is now around $15 higher than it was back in January. Gold has stumbled, the UK is going to have a new prime minister, and bond yields briefly look like they might soar higher before easing tensions in Iran have seen them cool again. Meanwhile, the Magnificent Seven stocks like Amazon, Google, Meta, and Apple, which have dominated for the last few years, or 10 years, or 15 years, have begun to underperform as concerns grow about the returns on their huge spending plans regarding AI. Today, we're here with Charlie Morris, our CIO, who's going to take us through all of this and much more. But before we get to that, a quick disclaimer. Firstly, this is all meant for educational purposes and should not be taken as investment advice. And a second thing to note before we get started in full is that there is a Q&A, a question and answer session in the second half of this call. So if you do have questions, please send those in using the chat box and we will tackle those and look forward to tackling them together in the second half. But I think with that, Charlie, it's over to you to talk us through the state of global financial markets.
Thank you, Kit. And before we get there, just to remind you, today we're talking about the multi-asset investor. Essentially, we're a research company. We're going to touch on the Atlas Pulse Gold Report, which is a free monthly, and the other two equity services, Quality and Venture. So all of those will be covered, the latter ones to a lesser degree later on. So first things first, what's happened this year in major markets? So we've got equities and gold. And gold started off very, very well before crashing and rallying and falling again into the end of June. Small rally in the last week or so, but not much. But on the equity side, we've had this huge return in emerging markets, and it's nothing to do with China or India growing rapidly. It's all about microchips, and 45% of the index is tech hardware, and that's just roared. And the same is true with Japan, that picked up some of these stocks as well, to a lesser degree, but had some of the excitement. The US in black with UK and Europe lagging behind a little bit. So that's the setup of what's happened this year. The story of the quarter, no doubt, has been semiconductors, and this is 10 years of the SOX index, the Philadelphia Semiconductor Index, which is 20-fold over the last 10 years. And the bottom line shows you that there was a big boom into 2020, and then they've been neutral to the world index, and then another boom over the last year, where they've done twice as well. So, quite extraordinary here. And I think, as I highlighted recently, this hit $16 trillion of value, these stocks listed in America linked to semis. And that's the same as the entire European and UK stock markets. And 10 trillion of those dollars were created in the last year. So it's really crazy stuff. The momentum effect, something that I've touched on many times over the years, and it's not something I've participated much in recent months, but certainly in the last quarter we did have a little trade there because it was starting to look quite interesting. But the bottom line is that going back 25 years, the momentum effect is on fire. I mean, it really is strongly overdone, and that should really cause us for some concern. And we were in a similar position in 2007, and of course in the late 90s. And I reiterate, this data set was only created in the last 5 or 10 years, and so I don't think it's very accurate pre 2010 or so. But nevertheless, we know that there was a big surge in 2007 and a surge today, and this is not normal, and we've got to keep reminding ourselves that's true. But some people say, it's not about the stock price, it's about the earnings, because the earnings are driving the current strength in stock markets. And that's fine, that's true. But earnings can also have bubbles. And, we've had basically about a 7% trend earning growth in the S&P 500 over the last 30 years. And again, in 2007, earnings were ahead of events. in things like real estate and commodities and financials, and that didn't work out too well. And it's happening again today. And I think, Kit, what was that thing that Buffett was saying about earnings?
Well, he used to say profit margins would sort of mean revert to around 10%, and that if they ever got out of hand, they'd be brought back in line either through competition or by the ballot box, which was a nice way of saying either competitors are going to come for your margin or voters are going to claim it back.
Yeah, put simply. So this can't last. There's also the concentration issue within cap-weighted indices. And obviously, cap-weighted indices have become so popular. That is, you own the top 500 stocks or the top 100 stocks or what have you, and the biggest ones get bigger and bigger and bigger. Now, that doesn't have to happen under all circumstances, but it's certainly happening when huge amounts of money are coming in each month, every month to passive investing. And of course, if it went to active investing, that active manager will be saying, oh, what's offering good value at the moment? They'll be putting the money into that. The index doesn't ask that question, it just shoves it straight into the biggest stocks. And here's the top 500 stocks weighted by market cap in red and equal weight in blue. So equal weight basically means 500 stocks, 0.2% per stock, rebalanced quarterly. So that means the rebalancing is a pro-value strategy. And I think you probably know about that here at ByteTree. And the other point is we've got a size effect. We've got a mid-cap bias because we've got more money than we would do otherwise in the mid-cap stocks and less money in the large cap stocks. So that kind of turns you into a value fund by default. And in the red line, of course, we've got the market cap. Now, it doesn't surprise me that over 35 years that the equal weight has outperformed, 10% actually over 35 years, not very much. But I would expect that to be more over the long term. Now, we had the bubble years in the late 90s and the bubble years recently. On both occasions, we've seen a 30% underperformance of equal weight over cap weight. But look what happened when it turned. So 2000 to 2015 or so, we saw 105% outperformance. So let me just zoom in on that. And so we started in March 2000 with equal weight index, you doubled your money over the next few years, whereas you just about got it back with the cap weight. And I think that's really illustrates the point. Now, the next chart's going to look exactly the same, but it's completely different. So look at that. We're now on value versus growth. And I have changed slides. Now, you think I haven't. That's the performer slide, and that's this one. They look the same, don't they? I've even chosen the same colors. And we're now looking at growth and value. Yeah. And the growth stocks in red went down a long way, and the value stocks went down much less and then carried on rallying. So I do think we're faced with a very similar situation. On the sort of bubble indicators, this is the margin debt. So they basically look at all the brokers on Wall Street who report all their client data, and they see how much margin they've got. And the margin debt is at record levels. Now, this is only May data. We haven't got June yet. And so it would be higher than that, no doubt. And, we saw 1972, 76, 82, 87, 2000, just before the credit crisis and the whole 2021 bubble. So, it has been on the nose, this indicator. And here we are there again. And I've highlighted this many times over the years. I remember highlighting it 2022, saying how the market was quite oversold and it was time for it to start rallying again. So that was pretty interesting. I think we kind of know what's going on out there. A very overbought, a very concentrated, a very highly valued, heavily borrowed market. And then we've got the other dangers, things like the oil. We've highlighted the risk of oil shock. Whenever the oil price does go up a lot, that's dangerous for markets. These reserves in America keep on going down. They went down a lot for Ukraine, and they've gone down a lot for the Straits of Hormuz. That data will be updated today. There was the hope that it was slowing in terms of its rate of decline, but of course they've just pulled the plug on the whole peace deal today, as far as I can work out. And besides which, over the last couple of weeks of peace deal, the number of ships sailing has been very, very low. And there's the question, as I keep saying, fine, maybe the ships get to leave, but will they ever go back? And so there's a huge risk of a short-term oil shock. And that's not to suggest that that in the long term oil won't be plentiful and cheap and electrification will continue. That's not the point. It's here and now. Are we going to have a squeeze? And I think the risks are high. And there's the oil price. Brent crude over the last year, it was dirt cheap earlier this year, started to pick up, spiked in March, but then basically it's been brought down by continuous announcements of peace deals and so forth, and workarounds, incredible workarounds. The Chinese imports really collapsed, and then we saw places like Nigeria and Russia increasing, and American doing their exports as well. So somehow or another, it's all worked out. But you wonder how long this can go on if it's really at the root of it is declining inventories. So on to the big picture with markets. We've got the 4 factors, the money map, which I'll come to in the next slide. But essentially, the green line is momentum or growth. I use it as a proxy. We did have a question about that. I answered it yesterday in the multi-asset investor. But basically, momentum is basically growth stocks with the animal spirits attached. I think it's a good way to demonstrate it. That's been very good over 10 years. Gold was great, and it's come back aggressively. I mean, really aggressively. So that's quite notable. The red line is value stocks, and value stocks hilariously include semiconductors. So semiconductors are considered to be cyclicals by the market, not growth stocks. And so when the demand for compute power starts to wane again, the price of semiconductors will fall, just like commodities in general. And then the ByteTree quality product launched a year ago, and we're going to touch a bit on this later. But basically, that's the quality stocks massively underperformed over the last 10 years in an exciting market for everything else. And that's really why we thought that the world's greatest company shouldn't underperform for this long. It was a good time to launch the product. And we're very excited by quality stocks because they are the anti-bubble. They are the safest place to be in the market. So this is the money map. To recap, when inflation goes up, we like to own hard assets. And when it's low, we like to own human ingenuity. Let's call it that. On the right, we've got risk on. On the left, we've got risk off. So gold, an alternative to gold for inflation protection, would be tips. And and on the risk on side, value stocks in general. And value includes commodities, heavy industry, and also quite a lot of financial stocks as well. And on the bottom, major stock markets in red, and particularly growth stocks, and then quality in bonds. Now, Kit, there was a question, so I'm going to take it here because it was written in.
It was. Someone just asked about the money map, saying that equities in the bottom right, they just had a question about the definition of that, given that you've got value, you've got quality, and you've got growth also represented, which are either part of or also equities. So just how do you differentiate equities from those 3 specific groups of equities?
Good question. Now, equities, the vast majority of equities, stock markets, when stock markets are going up, we tend to be in that red environment where they're doing best. And part of the stock market would be value stocks. So there'll be some financials and heavy industry in the stock market, and then also be some quality stocks as well. Now, for most markets, that would be not that much compared to the growth element. So take the S&P 500, you've got a hell of a lot of the growth stocks in there. Take the FTSE, you've got a bias towards value, lots of financials, lots of natural resources. Take the Swiss index, you've got a quality bias, lots of healthcare and lots of consumer staple stocks. So, the Swiss index is probably more blue, the FTSE is probably more black, but the S&P and most major markets are basically red. But it's not just equities that I could put in different boxes. There's different types of bonds. So we've got bonds, and by in the blue box, that means conventional. We've got tips, the inflation protected, in the gold box, and then corporate credit I'd probably put in the red box as well. So you could do the same exercise with real estate or anything else. But by and large, stock markets like the condition of red. I would suggest low inflation growth. Onto bond markets. That's the 10-year bond yields over the last 10 years, and we've got gilts at the highest, which is not a good thing, by the way, but they are the highest. And then we've got the US Treasuries in black. Then we've got the Germany or the Euro generic in red at 3%, being caught up by Japan as it normalizes its yield curve. And then China, the outlier, where the yields have been falling due to their real estate crunch. So I say basically the last few years for the major markets have been pretty stable. compared to the chaos that we had to face in 2022 and 2023. And zooming in on the UK and the US, where the bond markets have always been pretty correlated, the good news is that we've seen a narrowing of the spread. So on the red line below this year, it's come in a little bit. So we're no longer worrying about the UK budget quite like we were, or maybe we're not quite so worried about UK inflation like we were. Maybe it's not the budget deficit. But in any event, we have the new Prime Minister, Andy Burnham. We can call him Lucky Andy so far, because that spread is tame. If that blows out, he's going to have a problem. On to gold and silver. We did let go of our silver, which was a fabulous trade. The gold silver ratio obviously is a highly correlated asset, and the bottom chart shows the ratio. When it's high, then silver's really cheap. When it's low, silver's expensive. And right now, silver's average. So I'm not really tempted to add to silver anytime soon. But I'm really still very bullish on the precious metals trade in general, which I'll come to in one sec. But the other thing is we own physical gold in the soda portfolio, which is obviously less volatile and less risky. And then we own the gold stocks in the whiskey portfolio. And the performance has been very, very much 1-for-1 this year, which is quite interesting. I mean, it's been a bit of a range, but the black line shows that we had a strong revaluation last year. And I think gold would have to fall quite a lot for the gold stocks to start really underperforming, because it's still a high number and they're very, very profitable companies. And so I'm very comfortable staying long gold stocks in general. And I'm very bullish gold. Maybe not right now, but long term, it's going up. And I think there's a very simple argument here. And, I've made many arguments in Atlas Pulse over the years. And I think you can bring it down to one really simple one. And, it's a fact that, a third of gold or so sits in central bank reserves. And so long as central bank reserves are growing, gold's got demand, got structural demand. And you can see that in the 1970s when the reserves picked up strongly, there was a massive rally in the gold price. They slowed in the 80s and the 90s. The 90s in particular, the emerging markets were having a crisis and so forth, so reserves were being raided. But they picked up in the noughties massively. That helped the gold price. And they've been slowing since really that 2015. But of course, since the Ukraine war, the share of reserves has been going up. So, we have reserve growth. It's a little bit stronger than it was 10 years ago. And that's fine. That underpins gold alone. But also the share. They now want to own more gold than they do US treasuries in the basket. So we've got reserve growth and then structural demand for gold. Then this bull market is underpinned. And I think the most important point I made was in last month's Atlas Pulse. If you're not a client of ByteTree, but you're interested in what we do, this is a free report I've written once a month since 2012. Not every month. I think in the bare years I might have taken the odd month off. But the point I was making was that real interest rates are really high at the moment, and gold bull markets start from higher interest rates. They don't finish at high interest rates. So that would be a most unusual situation. Sure, real interest rates are high and they could go higher, but if that's true, it won't just be bad for gold. It'll be bad for a lot of asset prices, I think. But the real point is they'll start coming down at some point. And that will be a real lasting tailwind for the gold price, which is a good thing. And just to touch on Bitcoin, because I don't talk about it much in the multi-asset investor. Again, I write about it separately, again, for free. But we've got the inflation expectations in red, which were bouncing between 2 and 3%. And they've obviously come down recently because of the outlook for peace in the Middle East and the retreat of the oil price. The bond yield's been going up in green, because that's Kevin Walsh, the new Fed chairman, who's sort of, suggesting that he's going to be a bit of a hawk. Maybe he is, maybe he isn't, but the dollar's rallying and the market assumes he is until proven otherwise. But the bottom half of the chart is the real interest rate, the 2-year real interest rate. And I've always said that the gold price is much more reactive to the 20-year, the long-term real interest rate. But the big bear years for Bitcoin were 2018 and 2022 and 2026, 526. And that's, these have been times when the the real interest rate has been rising, and it's now at a very high number. And so I think that's good. If it's a high number, it's going to go lower. So I think both of these assets we can be comfortable that they're going to get a bit sooner or later. And just to remind you, over 10 years, there's the price of Bitcoin against semiconductors, and even they touched each other in 2019. And semiconductors have had a huge return, but Bitcoin is just it's a high return asset. It's taking a break, and that's that. And to put it into sort of IRR terms, since the peak in 2017, we've got this sort of 42% ascent, and it's 1 point something standard deviations oversold, which is not dissimilar to where it was in 2022. So there you have it. Bullish gold, bullish Bitcoin. Write about this every single Wednesday. I write about this, and the top bit's for free, written by me, and the second bit's the crypto portfolio. The question of correlation between gold and Bitcoin comes up, and yes, it is slightly high at the moment. It's 35% on an average of 10 over the last few years. But let's face it, that's not high correlation. High correlation would be 70, 80, 90. This is still 35, and we could deem it to be high. But all the times it's been above average, have it coincided with big moves in the dollar. So right now we've got a strong dollar, and that tends to pick up all hard assets and make them correlated in the short term. And then to touch on bold, whilst we're here, over the last 5 years, Bitcoin and gold, both of them are ahead of the stock market. It's just been a bad few months for these alternative assets, but the prevailing winds have been way ahead of the stock market, and there's just been a bit of setback. But as I keep saying, the best way to own Bitcoin and gold is through the bold strategy, which you can follow yourself, and that means following our weights, which are on our bold website. Now, bold, I'm asked all the time, will bold be joining the soda portfolio? And the answer is no. Bold is not going to be joining the soda portfolio because, firstly, it's not on Hargreaves Lansdown. Secondly, there's a crazy test you have to take, and it's very hard. You have to basically admit you're an imbecile if you want to buy this product, because and you want to lose all your money. You have to sort of say these things, which are just frankly untrue, but you have to tick those boxes, and then it's not even on Hargreaves, but it's on most other platforms. And then once we're through all that, there'll be some people who say there's a conflict of interest. So Bold will not be in the soda portfolio, but there again, it's a fantastic product, and it's out there for those who want to own it. Okay, onto the whiskey portfolio. Just to touch on performance, it has been a tough start to the year. I think at the end of January, we were up 9 in the whiskey portfolio, so that's come back, and we're now below the FTSE 100, which is always slightly embarrassing. It has happened before. It's happened in 17, which was a bubble year, and 21, which was another bubble year. So I think you can conclude that I'm not very good at bubbles, but I don't think that situation will last long. Indeed, the last week we saw a bit of a turnaround, and we have a lot of exposure to quality in the portfolio at the moment, and we have commodities. And these things are index outliers, but both of them I think are going to work quite well. The longer term numbers, there's a decent superior return in whiskey, and the volatility ironically is slightly higher than the index, and that is because the index volatility has been coming down, which is another story. But the Sharpe ratio of the whiskey portfolio, risk adjusted return, still very good, and we're over 10 years now, so that's good. And there's the picture. And to remind you, pre-2023, we recorded monthly data when I was at Southbank doing the Fleet Street letter, same portfolios. And then since they came to ByteTree, we now record weekly. So that's why they wiggle around a bit differently now compared to the past. But 2020 reminds you, if you have a defensive portfolio and the market rotates aggressively, this can be your best outcomes. Onto the soda portfolio, again, not doing so well. The theme here is basically, lots and lots of outperformance until 23. And it's been these big S&P runs when there's been massive outperformance for US stocks is when we felt the relative pinch. But a strong year last year, which made up for 23 really, and then a bit of a setback this year. But once again, our portfolio this time is much less volatile than the market. I mean, 6.5 is really low. And I'm very happy keeping it that way because I think some clients are genuinely scared about markets and what might happen, and they're right to be because there's lots of unknowns. We've had many major moves on the back of Trump statements, and you just don't know what those are going to be. And worse still, I think, is when they stop working. His ability to guide the market is going to be exhausted. But obviously, he's quite good at guiding the football referees, but that's another thing. And there's the performance. So not massive outperformance over the years, but good. But I would remind you that the FTSE Private Balance is world index. It's not FTSE UK centric. The UK 60/40 would be half the black line, roughly speaking. And so the outperformance over a UK 60/40 portfolio is very significant. But obviously, there's huge amounts of tech stocks in there, which is an absurd notion for a calm, balanced portfolio. Okay, and then, beg your pardon. So we're on to quality. And as you saw the slide earlier, we launched that last September. And I think there's one stock to go before we can actually call it formal launch. Kit, what do you think?
Yeah, well, indeed. I think we launched start of September 2025, and we spoke at the time about how it was going to be a bit of a process to build a portfolio and that it was worth starting early because we were seeing the early signs of a quality recovery. The Iran war, a higher oil price, higher interest rates maybe took a little dent out of that during the last few months. But as soon as it's come to an end, we've seen that continue again, sort of into quality, into Europe, all the places we're looking. So yeah, one stock to go. We've got it, we know what it is, and we're working on it.
Fabulous. Now, I've actually got a question for you, Kit. So it came from James Ferguson, who's a guru who writes at the Macro Strategy Partnership. And he says he looked at this slide, and sorry, let me describe the slide first. It's the min vol stocks, so the least volatile stocks in the market, and how they behave. Now, are these quality? Not imperfectly. I hope that we would materially beat this because we're buying cheap stocks and we're buying great stocks, and they also tend to have low volatility in 9 out of 10 cases. And so I think it's a reasonable proxy of what's happening out there. James said, I wonder if the 25-year double bottom in quality, quote unquote, and that's the red line, the double bottom being 99 and today. He says, I wonder if the double bottom in quality is the most important turning point for a generation.
Yeah, well, you look at that chart and you can certainly make a case for it. I think it's very interesting, given everything you've said, noting the growth bubble, the tech concentration, and the comparisons with 2000, that's just as visible here again. And that was a fantastic time to buy quality, not just for the, I guess, 2-year resilience that it gave you between 2000 and 2002, but then for the 20-year period thereafter. And as you said, these are the low volatility stocks. So broadly, they're getting investors to the same place with a smoother journey along the way. But equally, if you do get your timing right, you buy them when they're out of favor, you buy them when the market's looking elsewhere. You can add alpha to that over a decade or two as well. And that's what we saw. That's why we've been building the quality strategy. And that's why we're so excited about it today, is that concept of a 25-year double bottom. So, yeah.
Going back to that question, when I was talking about the money map, what's missing from the asset allocation in quality compared to an index fund? Where have we got loads more and where have we got loads less?
So the most obvious place where we have loads less would be technology, especially hardware and industrials as well. And those have collected into all the themes you talked about earlier, which is AI, data centers, hardware, and electricity grids as well, because of the power needed to drive those data centers. Those are all popular. They might be fantastic companies, but they're popular and they're highly valued. So they're sort of easy for us to ignore, because what we've seen is defensive quality stocks, things like consumer staples and healthcare, where we're over allocated here, being out of favor, and actually capital has flown out of those sectors into the other ones. So they've formed what we're calling an anti-bubble. And we notice that every time a bit of air comes out of the bubble, you can see that capital flowing with great impact back into these sectors, and they do react strongly because as you described how the semiconductor index was the same size as the European and UK stock markets, which means a small difference in that one sector can make a big difference to the rest of the market. So we're over allocated to consumer staples and healthcare. And then we also avoid areas like commodities and banks, because those are things where, whether it's the commodity price or the interest rate, the key driver of their returns, I guess, is out of their control. Whereas we want human capital businesses where the drivers of 5, 10, 20-year returns are in their power, led by great management teams with great cultures, great products and brands. So the only financials exposure we have there is more to do with insurance. And then finally, I'd just give a nod that we do have, we spent obviously the last 6 months looking at the crash in software stocks, which would formerly have been thought of as quality, but were very richly valued. Those have now crashed, they've come down, the valuations are attractive. And we've done a lot of work on how exactly AI is disrupting and I guess moved from what can't AI do to what is AI actually doing? Where is it playing a role? Which companies are resilient? Which are the cheapest? Which are the best? So there's a software allocation in there as well.
Brilliant. Well done, Kit. And I think that it has been a fantastic journey this last year. 24 stocks in, last one to go. Kit's been writing these 7,000 word detailed notes on these stocks. And the idea is they're held for quite a long time. So it's quite a low turnover portfolio with a growing dividend stream. And for those who want to slow down and have great companies with lower turnover, quality is a great option. And then lastly, I want to touch on ByteTrend before we go to Q&A. This is a major thing that's happening at ByteTree. I mean, I think that one of the things we've been underselling for a long time is how much goes on behind the scenes and the sophistication of our tech and modeling and that sort of thing. People say, oh, it's just a newsletter. Well, there's a lot more behind it than that. And ByteTrend is something we decided to go public with, and it's going to be a standalone product. Hopefully from August. Many of our clients, our pro clients, are testing it for us right now. And I just want to give an illustration of, you can pick up early trends pre-sorted by this box here, and we were spotted merging with other databases we've got. There was clearly a pickup in healthcare, as Kit was saying, and more specifically in biotech, and Illumina came up and ended up into the venture portfolio. And I think that the logic for the biotech rally is very clear. We had a bubble in biotech stocks in 2015, and they've basically gone up sideways with an upward tilt while the Nasdaq's gone racing ahead. And I think what's interesting is that this sector is probably the most productive consumer of what AI has to deliver, higher computing and this idea of being able to solve the genome and where mathematics hits biology, as it were, and this is very, very exciting. So I think this is why we decided to do something in this sector. And what we're doing in ByteTrend is just measuring all the trends for all the stocks every single day, picking up signals of what's working, what's not working, so you can find the alpha. And you can do it two ways. You can use trend following to go and find bubble stocks and chase semiconductors higher, or you could do it to find early trends and find value stocks. So there are many different things you can do with it. You can also just use it for market intelligence and new themes that come along. So it's exciting stuff for us. And this is a classic ByteTree stock, isn't it? Sales up a lot and slowed a little bit, valuation right down, on its way back up. And I think you've probably seen that chart or variations of it in note after note from us over the years. We like to buy things that are cheap. So that's basically most of it. Thank you for your reviews. We appreciate that feedback. And it's time for the Q&A. Now we've got a few things that were sent in. Kit, do you want to take it away? And if you haven't, or you want to send a question, then send it into the thing on the screen.
Yeah, exactly. As Charlie said, the chat box at the bottom, we're looking at that. So if you do have questions, send those in now. We'll be grateful for them. And we do have some that came in before. So we'll start with those as your questions come in. The first one, Charlie, is someone who writes in and says they have roughly a soda whiskey quality blend. And several names do now sit in both the whiskey and quality portfolios in particular, creating some double exposures. And just asking how you suggest that readers should handle this.
Yeah, I mean, I appreciate that. I mean, I raided what I considered to be some of the more defensive stocks within the quality portfolio, and I just wanted the whiskey portfolio to have lots of ballast, and that's not something I would do normally. I always diversify with different types of stocks, but I don't normally chase after the world's most resilient, least risky stocks. And the reason I've done it is because I think we're going through a historical period, which is the high risk major asset bubble, and this thing you don't know if it's going to carry on for another 2 years, or if it's going to turn imminently. You just don't know. And so having a large exposure to the safe stocks makes sense. Now, if that plays out, we will move on. The whiskey portfolio will say thank you very much for that relative performance and stability, and it will move on and go back to what it did before. But I think that I don't think it's going to be a regular feature that there's going to be stock crossover in the portfolios, but it will happen from time to time. Ultimately you want to do the right thing for the portfolio, and so if that means crossover periodically, so be it.
Indeed, and I guess from the quality side of that as well, currently defensive quality is the most attractive part, but there's lots of parts of the market we don't currently own because they're too overvalued and too overcrowded. If those spend the next 3 or 4 years going down, there's a whole different set that quality rotates into and changes as well. So that's not a static strategy either, which I think is crucial. A follow-up question for you then, Charlie. Again, a client's considering who has all three, maybe taking out the whiskey portfolio gradually and leaving soda and venture together, maybe sort of roughly equally weighted. But they do have a question asking whether the venture portfolio is designed partly with diversification in mind as well.
Yeah, absolutely it is. And I think that it was, it started as a tip sheet. And I think that all these things, you get the inspiration. I think it was late 22 or 20, no, 23, wasn't it? In September 23. And I just saw this crazy undervalued small caps in the UK particularly. I said, we've got to write notes on these. And they weren't suitable for whiskey. They were too illiquid or too small or what have you. So we launched venture, and some people enjoyed that, and we had some great success. And then it was a matter of what's its longer term role. We can't sit there trying to buy UK small caps forever. It was a cyclical idea, and these things come and go. And I didn't particularly want to hang around in small mid caps. I wanted to do proper portfolios. And I think that as ByteTrend has got better and better, the opportunity to do a proper global portfolio just stood out. Yeah, and I think a higher return, higher risk global portfolio, which is difficult for a lot of people to engage with, because most brokers won't allow you to buy most of the stocks we're talking about. So you've got to go to a grown-up broker, and have proper market access to be able to follow these things. And so yes, it's a diversified portfolio, but it's an equity portfolio, so that's fine. And I think alongside soda, you need to have an equity strategy, and we have three offerings now. We've got the quality, which is your low risk, low turnover. And you've got the whiskey, which is a sort of UK centric with a bit of Europe and major market, which is sort of medium risk. And then you've got the global portfolio, which is higher return, slightly higher risk, but it's not high risk. I don't think it's diversified. It's got 33 stocks. So if you've got 33 stocks, I mean, not much can I'm not saying it can't go down, but when you're diversified, that averts the worst possible scenario. So all of them make sense as accompaniments to something conservative like soda. You could have all three. You don't need all three. You could have two. You could have one. I think it's whichever one suits you as an individual. How engaged you want to be in markets. Very simple. But yeah, venture is a diversified portfolio.
Perfect. One final question on sort of client and appropriateness in the portfolios is someone asking for older readers, maybe, are the soda, whiskey and quality portfolios still appropriate? Specifically wondering about the event of a severe crash with a long recovery period in the sort of main global indices. Are these portfolios still better than putting all the funds just in cash, index-linked gilts and gold and other things like that?
Well, I mean, you can check out, but I've never thought it's a good idea, because you don't know if the problem's going to be the pound. So as soon as you're in fixed income or in cash, you're taking a huge bet, which is on the pound. Yeah. if that pound goes down, so you better hope that Burnham's really good, yeah, because if he does lefty stuff and the pound goes down a lot, then you've lost a lot of your purchasing power. So yes, in the short term, it might feel that cash and bonds are really attractive, short-dated bonds and things, but actually they have exposures which are pretty scary. So I've always been a big fan of the diversified portfolio. I don't think it's really that easy to check out of investing, and much better to maintain the ongoing journey. But if you don't like volatility, I don't think the whiskey portfolio is particularly risky at the moment. It's got a high degree of it's very diversified, and it's got a abnormally large exposure to quality stocks, and what's not quality is value. It's basically pretty cheap. So I don't think that it's a particularly risky portfolio at the moment. That said, if you're worried, then the quality portfolio is the least risky equity portfolio that we offer. And so sober and quality would be a very calm way of stepping forward into this uncertain world, which I think is just repeating what I just said in the last question. But yeah.
No, but a great answer. Thank you. Someone has asked just about a few companies in particular, and they've singled out Diageo, Unilever, and Persimmon as things that we hold, and they understand the thesis, but they just look for an update on given the price action so far, and they were happy with Persimmon. So maybe I'll take the Diageo, Unilever ones. Firstly, with Diageo, people have been drinking for thousands of years, and we think they will continue to. There was obviously some concern post-pandemic around people drinking less. We definitely saw a surge in alcohol consumption during the lockdowns for obvious reasons, and I guess a calming down of that in the years that followed. Some people felt that subsiding was a permanent feature. We felt not, and we are starting to see evidence coming through that people who'd given up on it were picking back up, and that the health concerns, which are totally valid, are also not to be completely overweighted relative to the social benefits of drinking. Andy Burnham talks about pubs being the centre of a social community. Jeremy Clarkson's doing the same in Clarkson's Farm. So we're seeing, I guess, that narrative around drinking pivot. And then Dave Lewis, who did a great job at Tesco, has come in to be the CEO, and he's starting to get the engines firing as well. So we like Diageo. They have the best brands, history, quality, and that's starting to pick up nicely. So we're happy with that. And then with Unilever, yeah, there's been some changes. So a new CEO came in from the beauty and wellness sort of section of the business. That's his forte. He has a great track record in it. But now they have a big activist on the board who's been pushing, I guess, to break up the sort of conglomerate food, beauty, home care structure, and that is now happening. So they've sold off the ice cream to Magnum Ice Cream. The food products business is going over to McCormick in America, and these are big changes. Terry Smith, a long-term holder and lover of the stock, has sold on this basis, also because he felt the communication wasn't right from the management team. So there is definitely some questions around that. For us, firstly, the beauty and healthcare side of things from Unilever are higher margin and higher growth, and that is where the CEO had his experience and did really well. So we're giving him the benefit of the doubt, and we're giving those products the benefit of the doubt. Also, Unilever is continuing to behave as the Unilever investors know and trust in terms of how it behaves relative to other parts of the market. So it's still the same Unilever. We think the CEO is good. We're giving it the benefit of the doubt, but we're aware of the questions floating around it as well. So hopefully that covers that. Moving in a different direction, Charlie. Someone has asked about China, specifically around its low valuations, the sort of persistent valuation gap with America, maybe to do with political risk, but also the signs that investor flows from abroad into China are increasing. So you've got low valuations, you've got inflows, but you also have political risk. How do you see China at the moment?
Well, I think China is probably more normal than I think we give it credit for. And I think investors would pay more attention if America wasn't so fascinating. If it didn't keep banging out all of these spaceships and things, then I think people would spend much more time looking at China. But because it just gobbles up all the attention, SpaceX and chips and AI and all that, people don't bother. I mean, emerging markets, as I say, used to be a fascinating part of the stock market, but even then they've just been overwhelmed by chips. And India, this is sort of forgotten, having been a star market until a few years ago. It's forgotten. China's forgotten. Indonesia's been kicked out of the indices. I mean, it's extraordinary what's happened. And so I think that China has its problems with the low interest rates and the real estate bust, that's for sure. But it also has hugely innovative companies. I mean, did I read at the weekend that the JQ 3 or did JQ 3? No, the JQ 7, which is the sort of fake Range Rover, is now the third best selling car in the United Kingdom, and is 29,000 quid. And it's extraordinary, what's happening and how successful China is in so many areas, and in AI as well. And of course, we own some of those internet companies through EMQQ, and other things here and there. I think that China is not the enemy. It's not Russia, but it's not a liberal democracy either. It's something different. It's an Asian version of democracy, and which is not democracy, and without a vote. But it's run for the people, and they're pro economics and pro profit. So I think that in many ways they're just like us. In other ways, the system is very, very different. But the capital flows have been very weak into Chinese markets this year, particularly Hong Kong, which is the outward-facing market. The domestic A shares have been stronger, and there's the hope that some of these tech stocks is going to surge like Korea and Taiwan. We had a go at that in Whisky with China.
Indeed. A follow-up question just about another tense region. I guess there's been a lot of focus on the Middle East, but the situation in Ukraine does seem to be changing. It's obviously, I'm not a military analyst, but the read is Ukraine's chances are improving. Donald Trump's position is ameliorating. Where do you think markets sit at the moment regarding Ukraine and Russia and the risks there?
Well, it comes back to oil, isn't it? So neither market is in global capital markets. I mean, Russia were excluded at the days of the invasion, and Ukraine, I don't think it's been excluded, but it's irrelevant. So in those terms, not much. But I guess in commodities, food from Ukraine and oil from Russia, it's relevant. But I think that they remind us that the world's a very uncertain place, and the defence industry needs to be taken more seriously than it has been. And this is on the front page of the newspapers. So absolutely. But it does strike me that the chances of some sort of ceasefire have increased because Ukraine's attacks on Russian oil infrastructure have been extraordinarily successful. And I've read that the Russians have actually have had to be importing fuel. They've got car fuel shortages left, right, and centre. And this is not how it should be. But yeah, so there's just more disruption in the world, which people will notice and talk about more when we stop talking about SpaceX and AI.
Yeah, I think that's a fair comment. One more of the questions from before, and that's that someone writes in saying they've just finished the crypto ETN test in the Stratify app and hope to be able to buy Bold there from tomorrow or very soon. The Stratify app, is that one on your radar? Do we know about that one, Charlie?
Stratify are amazing. They're a young fintech firm, and they build these portfolios. They're very quant in what they do. They're quite fun. They're kind of I think they're a DFM for the IFA industry. I think that's what most of their money under management is. I went to see them some months ago, and they loved Bold, and so they bothered to come up with one of those new innovation ISAs, which all the other platforms like AJ Bell and Hargreaves haven't bothered to do. They said crypto won't get into the ISAs, but Stratify have done it. So well done, Stratify, and well done to the client who wrote in for pursuing that channel.
Indeed, yeah. Thank you to that client. We've had a couple come in the live Q&A. Firstly, just asking about Nestlé compared with Unilever. I guess following what we said earlier, Unilever is now more focused towards beauty, home care, and away from food. So together they now offer more diversification than they used to, although Unilever shareholders will keep shares in the combined entity once it's gone over to McCormick, and there'll be decisions to be taken there. Nestlé following quite a similar pathway. New manager, cutting headcount, focusing on efficiency, and rethinking things around package sizes, product sizes, pricing, facing the same inflationary pressures. They operate in many similar markets. Two great companies, and now slightly more distinct from each other than they were in the past. Um, Another question around quality. Charlie says that the
I
quality
love it. I just see it. I love it. I love this question.
Yeah, the quality ETFs are showing over 50% returns over 3 years, which doesn't seem to match our quality chart. What's going on there?
So the quality has got, I think you mentioned it earlier, it's got different definitions. And in the good old days, quality for someone of my generation is high return, high margin, low volatility, stable, non-cyclical businesses, Buffett style, the sort of thing Warren Buffett would own. Okay, that is what I define as a quality stock. And then it's been, because it became very popular, saying, "Oh, we're just doing the good stuff and outperform long term." Then everyone tries to re-engineer everything to make everything quality. So the quality ETF that the gentleman referred to, its biggest stocks are Apple, Microsoft, Nvidia. I'm reading it off the screen. I'm looking at it. Meta, Lam Research, Applied Materials, Visa, KNAC, the bubble. So they're top. Basically, they're just saying all these stocks with high margins are quality stocks. But of course, they're all volatile. Our version of quality is calm. It's anti-bubble. It's something that's a very gentle dividend growth journey, whereas these things are all at the cutting edge of news flow and hype. So it's a completely different definition. And just as value, I mean, value sometimes means cyclical, sometimes value means cheap. Here we've got quality, meaning the old school term would be stability, whereas the new school term would be rip off margins. And so this has been happening in markets for years, where you get popular language and then you just spread it to an entirely new area. But ByteTree Quality does not do bubble stocks. We're doing the opposite.
Yeah, I think the thing I would just add to that is I think where we're adding value is that quality is an umbrella that has grown to encompass more things as you describe. And while we see a quality anti-bubble, there is certainly still a quality bubble out there, and it is those stocks that you mentioned. They're great companies, but they're incredibly richly valued. Everyone loves them, and they're not wrong to, but it just doesn't feel like the right time to us, and they're not going to give the sort of calm return or resilience that we hope our portfolio will. So maybe those companies, if they all go down 80%, will become candidates for ByteTree Quality, but at this rate, they don't. And I think that's where having a guide, having us running that strategy is of value, because within the quality universe, there are distinctions to be made that make a huge amount of difference to what you own and how it's going to perform going forwards. One more question's come in. Can ByteTree launch funds, brackets, perhaps with a partner, that reflect each of the portfolios? It would have a fee, but would make it easier than trading each recommendation through a broker.
Yeah, it's a nice idea. Yeah, we're not rich enough to launch any more funds. We've launched a fund. It's called Bold, and no one's put any money into it. Well, some great people here have, but the world didn't buy it like it was expected. So, without one successful fund, you can't have two. So, if we had one successful one, then maybe we'd have two, and then three, and then four. And certainly until the first one's a success, then we will never have a second. I'm sad to say.
Um, Thanks. Well, hopefully that reflects an appreciation of your work anyway, Charlie, and we'll take that as a positive. But I think that's all the questions that have come in. Charlie, it was a fantastic presentation. It was obviously a really interesting quarter, so much happening. I don't know if you have any final words for everyone watching and listening.
No, I just think it's historically a very strange old time. But I feel like on auto, on replay here, because this would be saying this since 2021, and it's never happened before. Where you have a sort of a big bubble like we had then, and then half a bear market, and then another big bubble. It's come straight back. So it's all very odd, I think. But I do think we have to think differently. And just a thought, a moment of question. We had that question, didn't we, on the quality, and that's up 50%. And I read the quality stocks, which are basically all the bubble stocks. Now, why don't I use the MSCI Quality Index to show quality performance? And why do I use the Min Vol precisely to illustrate that point? Because I just don't think the quality index they publish is quality. I think it's growth.
Indeed. Well, from my side, I'll just thank everyone
Keep
for
going with Bob. Keep going with Bob. Of
keep going. Yeah, sticking to
course,
the
we'll keep going with Bob.
yeah, fundamentals, valuation, momentum, all the things that have driven those 10-year return tables that you showed us halfway through the presentation. Those are the things we're going to stick to, be disciplined, and that's all we can do. Right. Thank you everyone for watching and listening. Thank you, Charlie, for the presentation. We'll keep writing to you as always, and for the next quarterly report, we'll see you again in a few months. But we may be more active on YouTube between now and then than we have been. So keep an eye out for that as well. Thanks very much, everyone, and bye for
Thank
now.
you.